Hello, everybody, and welcome to the Leaders in Supply Chain podcast. I am your host, Radu Palamariu, Managing Director of Elcat Global.
And it's a great pleasure for me to have with us today Benjamin Gordon, which I will briefly introduce for those of you who don't know. But first and foremost, let me just welcome you, Benjamin. Thanks a lot for making the time and for joining us.
Thank you, Radu. It's great to be here and great to be with you.
Our pleasure. So a few words on Benjamin. He's the founder and managing partner at Cambridge Capital, which is a West Palm Beach-based investor in leading transportation, logistics, and supply chain technology companies. Benjamin, as part of Cambridge Capital, seeks to invest in high-growth companies in supply chain. Examples include Grand Junction, which was sold to Target, XPO, Cambridge Capital invested in XPO, Bringg, and many others. They add value through operating expertise, M&As, as well as CEO relationships in supply chain. And on top of this, Benjamin is also the CEO of BG Strategic Advisors, where he built the firm and advised on over 1 billion worth of supply chain transactions, including work with firms such as UPS, DHL, Kuehne+Nagel, Agility, Genco, and many, many others. Prior to the BG Strategic Advisors stint, also Ben founded 3PLX, which was an internet solution which enabled third-party logistics companies to automate their business, which was eventually sold to Maersk. So definitely an entrepreneurial past as well for Benjamin, which is not that common. So welcome, great to have you. And maybe let's start first and foremost, so there's a quick intro, but tell us a little bit, how did you end up in the first place in logistics? I think I was reading somewhere that, there's some company history as well, there's some family history as well. Maybe tell us your story first and foremost.
Well, thank you, Radu. I appreciate it, and great to be with you. My friend Isa Al-Salah had great things to say about his time on your show with you, and happy to follow suit of Isa and many other great folks you've had here. My journey here began, as you said, with a family connection. I had a truck leasing company that my grandfather started in 1948, and his grandfather started a horse and buggy business in New York in 1903. So in some respects, I'm fifth generation in this crazy industry. And I can't tell you that when I was 5 years old, I dreamed about logistics, but it was an area that I had some experience with, and an area that I came to know and like, and found a fun and rewarding area. And for me, a turning point was 1998. I was a strategy consultant at a Bain spinoff called CDI in Boston and Paris, and I had come back to go to business school. And I had been looking at the family truck leasing business, and I thought I had the perfect idea. I thought that I could come in and figure out how to harness the internet to use technology to help the truck leasing business. So the truck leasing business had something called dedicated contract carriage, which basically means you had contracts with customers like a JCPenney, and you would go out full and come back empty, but you'd be managing the trucks on a dedicated basis for the customer. So my thought was, why don't we combine what's happening in logistics with what's happening in technology and use the internet to broker the deadhead, so that when the trucks are coming back empty, if you use the internet, put it out to bid on the market, you could generate more capacity. Okay, so now it's 2021, and that sounds really obvious, right? But in '98, nobody was doing this, and so look, I think one of my weaknesses is I can sometimes overanalyze things and geek out. So I ended up writing an 80-page plan for how we could take AMI, the truck leasing company, and use the internet to sell the backhaul. And I sat down with my grandfather, who was a brilliant man, but also didn't have the patience for 80-page plans of this sort. And I got through about 5 minutes of my plan, and he said, "Ben, I got it. It's a good plan." And I said, "Well, you want to do it?" And he said, "No, I have a better plan." And I said, "Well, how do you know?" He said, "I'm selling my company." So he won. His plan was better. So he sold his company. But I thought, you know what? If this idea makes sense, I had to turn it into something real. And so I ended up starting a company called Threeplex. It was, today you would call it a SaaS logistics company. We called it an ASP, but really different words for the same thing. It was a TMS, transportation management system, that allowed logistics companies to really run their entire business. And so out of the the rejection of my first idea came a better second idea, which led to a real company. And that was what led me to start my first business and send me on the journey into logistics.
Well, there you go. What is family if not to give you a kick in the butt when you need it? So,
Exactly. Exactly.
and I remember we also had, and I don't know if you know John Urban, who set up GT Nexus. You might know
Sure.
John, and he was telling us the story of GT Nexus, and all these things that seem so obvious now, like your idea, which in '90 it wasn't obvious. The same with John. He was sharing like when he when he set up GT Nexus, right? He had to educate first people about the internet and what it means, and all those good stuff. And it took, I don't know, 5 to 8 years, I think, just to get people on board with the principle. So that's why always a pleasure to have people like you that have been, from the beginning to what is now almost, in some ways it's gotten to a hype. And well, there's a lot of interest definitely around the space. And wanted to ask you on, obviously you invest, right? You've had some extremely successful investments. You've exited some. You have a lot in your portfolio. How do you make these decisions, right, Benjamin? When you look at the company, and I was just over for dinner here in Singapore. I had dinner with a startup, right? So I'm curious, and the person was asking me, I'm curious, what are the principles? What are you looking at when you look? Okay, this is a good idea, a good startup, or a good scale up, or a good company to invest in versus not so good.
Right. Well, for me, there are four main things that we look for. The first is the market. Are they solving a problem that's big, such that if they're right, the payoff is big? And so, big pain point, number one. Number two is the solution. Do they have something that's unique, that's compelling, that has a moat around it? Number three is the people. I mean, in the end, deals, investments, it is all about people. We're not buying mines. We're not buying things that have major tangible asset value. We tend to invest in companies that are services or technology companies. So it's about the people. Do I think the founder is he or she a winner, likely to build and grow something great, someone that we could trust, someone that we could believe in, and someone that when you go through difficult times, you can count on to have great judgment. And then the fourth is the deal. Is there a deal that makes sense? You might have all those ingredients, but the company's being priced like GameStop or something that's just not rational, it doesn't make sense. So those are the four things we look for: big market, compelling solution, outstanding management, and a deal that makes sense. And when we see all those four in one place, great. And I'll give you an example, albeit in the very beginning. When we first looked at what became XPO, the story was as follows. Brad Jacobs, who of course now is a legend in logistics, actually was a legend in other industries, but had never done anything in this space. He had built 4 companies from nothing to $1 billion. And he came to us a decade ago and said, hey, I'd like to build my next company in the space. And people have told me that we should talk, so let's talk. And a few things became clear. First of all, the market opportunity was huge. What he really wanted to do was consolidate truck brokerage as well as adjacent areas of logistics. And that's a $100 billion plus market opportunity in aggregate. The second was the moat. Here, there wasn't really an obvious moat because it was originally a plan, but it led to investing in a company called Express One, which was outstanding in expedited freight. Well, expedited today is an area where, because of the desire for last mile, it's become very clear and very important. I would say this was probably the weakest of the 4 points, but in the end, the moat really was Brad. Brad was fantastic, which brings me to the third topic, management. This was somebody who had built 4 companies from nothing to over $1 billion before. It was pretty easy to see that, Brad was about as good as it gets when it comes to management talent. And then the fourth was the deal. And the deal was co-investing with Brad and buying a company doing 10 million of EBITDA. And we paid, I think, about 75 million, so around 7.5 times EBITDA, which, was a fair price. But, most importantly, it was aligning behind a strategy to scale something up to something much bigger. And of course, today, XPO is an $18 billion value company. And so, the hindsight's 2020. It looks obvious now, but if it was that easy, of course, everybody would have done it. But that's a pretty good example of how the things that we look for, come into being.
Mm. And I want to flip it. So that's an amazing success story. And yeah, Brad, I think no introduction needed. Great trajectory and all that was done. Let's talk about mistakes as well, right? I'm sure there were some. I mean, no need to name them necessarily, but curious what went wrong as well, right? I mean, I'm sure there were some bad decisions in the past as well, where it seemed like it's great and then turned out to be crap. Maybe share one or two of those as well.
Lots of mistakes. I'll start with a mistake I made in my first company. So with Threeplex, we thought we were building the world leading ASP for the transportation management systems arena, to help 3PLs automate their business. Several mistakes. Okay. The first was the premise of an ASP for logistics companies. You were talking about some of the, that 5 to 7 year journey for John, to get traction with GT Nexus. Let me tell you about an example. In one of my first 3PL customer meetings, I sat down with him and he said, Ben, your software looks great, but I can't use it. Why not? He said, it's just too slow. I said, what do you mean it's too slow? I mean, I'm using it on my computer. It's super quick. So it turns out I visited him and it was too slow. The reason it was too slow is he was using dial-up internet, okay? Now, again, this might sound insane, right? Like I don't even know if how many people who are watching or listening remember the weird ring of the modem when you're doing dial-up. But guess what? Dial-up was something like half the market 22 years ago. And so, yeah, if you were on dial-up, it was going to be too slow. You couldn't run your business on dial-up. It made no sense. So, like an obvious and in hindsight very stupid mistake was just qualifying our customers to make sure that they actually had the infrastructure to be able to use what we had. Okay. A bigger mistake, harder to anticipate at the time, was we went all in on this TMS model, but it turned out that a lot of customers were not really interested in adopting TMS. More customers, we ended up with a second product where we went to drayage companies and steamships with a system for communicating between the short haul trucking or drayage companies and the steamships. So when they come in with 10,000 containers and unload them, that process is seamless and there's an audit trail. Okay, we spent 26 million of R&D on the TMS. Yeah. And it was a great TMS. Okay. We spent 1 million on the drayage system. Guess what? Maersk ended up buying Threeplex because they loved the drayage. All right. So we spent all of our money on the wrong thing. Okay. And the lesson was, Jim Collins likes to say, fire bullets first and cannonballs second. And I love that concept, because what it means is you start with little investments, and then when you prove they succeed, you make bigger ones. Well, we were in the get big fast model, and that's great if you're getting big in the right area. But in our case, it was the wrong area. And so that was a key learning that came out of it. The last thing that I would say, key mistake there, was we thought we were selling to 3PLs. But what I ended up realizing was every 3PL that we pitched loved the software, but they didn't want to pay 7 figures for it. What they said was, well, why don't I bring you in and we'll go pitch one of our customers. We'll go pitch Walmart. We'll go pitch Apple. And if that end customer wants to pay for it, then great, fantastic. So my mistake was not realizing that 3PLs weren't really going to be the customer at the time. They really were going to be like a value-added reseller. Okay. And had I realized that sooner, I probably would have come in with a simpler, lower price point system that was easy for a 3PL to start with, and then do what you call today a freemium model, where you start with something cheap with the ability to upsell more over time. So those were 3 mistakes that I made and lessons that I learned from them.
Yeah, some more expensive than others, but like they say, there was an analogy where an employee makes a mistake that costs the company 2 million, and then somebody asks the CEO, "So will you fire him?" And then the CEO says, "Are you crazy? I just invested 2 million in his training." So all this add up, and here you are today, right? Because of all that. And I'm emphasizing because, as you know, and a lot of people watching and asking and are aspiring to be entrepreneurs, but there's a big fear of what if I fail, what if I fail, what if I fail. And ultimately, no need to fear, because you will fail, and you will fail a lot, to your point, but ultimately it's part of the journey. I wanted to ask you on the topic of 3PLs and what's happening, and I think you were part of a deal recently with, what was it, Werner and Scan Global Logistics.
Right.
And I think we had some exchanges also on some comments, and you posted a question at some point on LinkedIn if you see a consolidation in the industry. Maybe now your turn to share your thoughts and how you see it moving forward.
Sure. Well, so we have 2 businesses. Our investment bank is BG Strategic Advisors, and then our private equity firm is Cambridge Capital. So on the investment banking side, BGSA was engaged by Werner to sell their global freight forwarding business, which Scan Global Logistics bought. That was announced. It's actually not yet final, but in public company world when you reach a deal, even if it isn't final, needs to get announced. So it's this weird dynamic in the public world. But the bottom line is this deal is a really interesting example of consolidation in logistics. Werner is a fantastic trucking company. They're one of the largest and best regarded trucking companies in the US and North America more broadly for a reason. They also have a freight forwarding business, and it really wasn't core to the business. And I think what Werner decided to do, and this is consistent with what we're seeing elsewhere, when UPS divested their LTL business for $800 million, for example, it's a focus on core competencies. Stick to what you're great at. Werner is great at trucking and domestic surface transportation. So they decided to exit what for them was a non-core business, global freight forwarding. But guess what? That's the core business for somebody else. And Scan Global, of course, is 100% focused on air and ocean freight forwarding. And so for them, it was a great opportunity to buy a business that fundamentally made great sense for them, fit their trade lanes, fit their networks. I'm sure will do very well with it. And so, a classic example where both sides should win by focusing on what they're best at. The UPS divestiture of their LTL business to Transforce, in my view, very similar, because guess what? UPS is doing fantastic in parcel. Come back to something that we learned at our conference last week, which is that if you look at all the value growth in the transportation logistics markets last year, one of the biggest shifts was the shift to parcel. UPS, FedEx, and DHL added $110 billion of market value in a year, which is staggering, about a 40% increase in their market value. And a primary reason for that was the fact that because people have been working from home and buying more online, that's driven an increase in parcel and last mile transportation and logistics spend. Well, that's great news for the core business for UPS. LTL, not really the core business. So they said, let's shed that and get rid of it and focus on what UPS is best at and cares about most. But that LTL business is core for somebody else. And of course, it turned out to be Transforce, the Canadian trucking company that's been continuing to consolidate and expand their trucking and related footprint as well. So to me, this fits under the headline of really an increased focus on core competencies that benefits everybody, buyer, seller, customer, and the market.
And there seems to definitely be a trend there. And I think if I am to believe some of the rumors, there's quite a few other transactions, quite significant, that might be announced in the public domain in the next 3 to 6 months. There's also the interesting movements, I guess, that Maersk is doing into, kind of morphing into an end-to-end supply chain provider. CEVA, CMA, CGM, sort of the same move. How do you see the 3PL industry? I guess my question and what's on my mind in 10 years, Benjamin. You have a couple of forces, right? You have on one side DSV model buying more companies buying companies, like what we just discussed, right? The consolidation on your core. Another side, you see shipping lines maybe entering the space. Another side, obviously, is the big elephant in the room, Amazon, Alibaba. Will they go full at it, right? Curious of your thoughts. How will it look like in 10 years? I mean, not that anybody knows, but if you had to make a guesstimate.
So Raju, I would say three things that I see that will happen. One is this continued trend of consolidation. So if you think about it, 20 years ago, the top 50 companies in global logistics only controlled about 20% of the market. Today, the top 50 control more than 50% of the market. I think it's reasonable to assume, and within 10 years, I think there's a fine timeline, that top 50 could control at least 80% of the market. And that's because of the major players like XPO, DSV, and others that are acquiring and adding pieces to their empire. So I think that's one. Two is what I would call convergence. Convergence is really the blending of adjacent services. Amazon's a pretty good example of that because they're combining freight forwarding, truck brokerage, last mile, and other services. Amazon will ultimately likely be the world's largest logistics company across all those areas. Meanwhile, you have companies like, you mentioned DSV, bundling multiple services together. XPO, which has been bundling services, although there's a shift on the other side too, given that they're divesting the logistics business, which we can come back to later. But fundamentally, customers like the idea of having a more holistic solution. You want to have your air forwarding, your ocean forwarding, your port logistics, and your other services bundled under one roof so that a customer has kind of an end-to-end capability. And that's driving this whole service convergence. And the third core trend that I would say is the digitization of supply chain. So things that were once analog that are now becoming digital. It's very trendy among the classic, truck brokerage and freight forwarding businesses to dismiss the overhyped digital challengers, and all you have to do, we're talking about LinkedIn, look at some of the things that have been posted on LinkedIn about Flexport, for example. There are a lot of freight forwarders that have a lot of terrible things to say about them. And you know what? There are some valid points, but there's also the key underlying issue. The key underlying issue is that technology is playing a bigger and bigger role in logistics, and it's automating more and more of the business. I'm not one of those people that thinks that somehow truck brokerage and freight forwarding will disappear because the internet will automate it and disintermediate them. I think it's not about man versus machine. I think it's more likely man plus machine. In other words, I think the logistics companies that invest aggressively in technology and automation, those are the guys that'll be the winners. So when C.H. Robinson says they're going to spend, I think it's $1 billion on technology over the next 5 years, right? Assuming that money is spent wisely, which I expect it will be, that's going to serve them really well. I look at what Echo is doing. I look at XPO, which I think is spending $400 million on technology. I look at the major technology moves these supply chain companies are making. The ones that make those aggressive moves will pull ahead, and the ones that don't will fall behind. But either way, the digitization of logistics is clearly a trend that accelerates. And one last thing I want to add, a lot of the smartest logistics companies are going to buy digital capabilities, not because they couldn't create them, but because it allows them to get there faster, and because it allows them to bring more talent into their organization. You of course specialize in the human capital world, and the human capital that you could gain from buying a great technology company can sometimes be the most valuable part of the deal. I know it was one of the reasons why our portfolio company, Grand Junction, sold to Target, because Target saw an opportunity to get there faster and to bring in some outstanding technology savvy people. So those are three core things I predict for 2031.
No, thank you for that. And yeah, I wanted to add in terms of your comment with the technology. So one, my layman, let's say, observation is that there's more and more solutions to help traditional, let's say traditional, I don't know, there was a term that sounded a little bit better, but traditional 3PLs or versus digital freight forwarders, but there's a lot of solutions to help them digitalize. There's another reality, and there's some past examples that I will not name of companies failing fairly miserably when they try to do it by themselves, and they try to code by themselves, and they try to come up from within with a solution. So that's kind of almost proven to fail, right? So if you want to fail, try to do it by yourself. On the point with human capital, big thumbs up. Again, there's a risk, right? I guess, and maybe I'll sidetrack a little bit. There's a risk that the moment you integrate as a big machine, right? Whether it's whatever big company, let's not name them, right? If they swallow or they try to swallow a smaller, nimbler, entrepreneurial type of venture, a lot of times they end up killing it. Maybe I'll ask you as a follow-up to that, do you have some principles, some tips and tricks, what you saw that worked, right? So in this kind of, specifically with Target, right, there was a deal that you did yourself, you can talk about that, or something else where it works out well, right? Because a lot of times it goes pear-shaped, right? I mean, let's name Microsoft, it's a big elephant. They are very good at buying and killing it. Right. So some of their deals, right? So I guess what are some principles if you've seen in properly integrating such entrepreneurial, tech-driven startups?
Well, I think the Grand Junction Target story is a great example of integration. So Target wanted to acquire a business that would give them strength in last mile. They were competing against Amazon Prime, and they thought, if we don't find a competitive alternative to protect us from this, we could end up being squashed. So they were looking for technology to strengthen their last mile capability. And Grand Junction gave them that because it gave them an ecosystem of capabilities in last mile. But they also went to the management team and said, look, we're going to pay a great price, but we also want you guys to sign long-term contracts. And I don't know if it's public, so I won't disclose the details, but let me just say that they made sure that the people that were part of the deal would remain, a long-term part of the business. And it's not just a contract, right? It's also about giving them a path and a role that they would be excited by. I mean, I was involved in another deal we sold a company called Open Mile to Echo Global Logistics. This was, I think, about a decade ago. And again, they had great technology, but what Doug Wagner and Echo really wanted was the people. And so the CEO ended up becoming, I think, Chief Commercial Officer for Echo, and the CTO had become CTO as well. Now, it didn't last forever, but the point is that they not only figured out a deal that made sense, but also a career path on a personal level for those guys that made sense. And I think that's what a smart corporate acquirer has to do. Right now, involved in I can't disclose details because it's in process, but one of our portfolio companies is being courted by a strategic buyer. And we're going through the exact same, conversation because, that buyer, we as the owners of the company want the buyer to pay what we think is the full fair price for the business. But they're only going to do that if they know that the people remain a long-term part of the company. And so they are, of course, negotiating not just purchase price, but also job description and trajectory. And I think that's, that's vital because in the end, look, it's public. The purchase price for Grand Junction was 90 million. This is for a small tech company. How is a small tech company worth that much? Well, it's worth that much if the technology boosts your productivity, you win more customers, and the people become a part of the next iteration of building the business. And so, I think those are the three things that a buyer needs to think about when they're acquiring somebody in technology.
Let me pull this question that came through. So from Ivan, music to my ears, yet the sales cycle of corporates continues to be long and arduous while startups thrive on speed and need quick traction. What's the secret formula to overcome this? I think it's not only Ivan's questions, a lot of startups questions.
Right. Well, I think there are a couple of parts to Ivan's question. One is, if you have a startup, how do you get traction when those corporates tend not to have the sense of urgency that you have? And I think part of the answer is reframing the question. In other words, if you know where the pain point is and the sense of urgency on the other side, all of a sudden, things can move much more quickly, right? I mean, Target had a pain point. Target was willing to move very quickly when it came to last mile, because that was something that they needed to solve. But if you were a startup pitching Target and you didn't know that was their key issue, you could waste a lot of time going in circles. So, the biggest objective in the beginning is figure out who's your customer, who's the decision maker, and what does he or she really want. Again, my mistake with Threeplex over 20 years ago was thinking the customer was the 3PL, but realizing that ultimately the shipper was the one that was actually writing the check. So, if I were giving advice to startup or an early stage high growth company, and this is the advice that I give to our portfolio companies, it's number one, find the pain point. And then number two, figure out how to speak the language of your customer. Just to give you an example, one of our portfolio companies is called Greenscreens AI. Greenscreens AI automates the pricing engine for truck brokerage. Okay, so if you're in Los Angeles and you have a customer that wants to ship a truckload of freight from LA to Miami, and they say, well, I'll pay you X, $20,000 or whatever, and you probably think that's a great price, but you don't really know. You'd like to know on the spot what your cost of capacity is going to be. If you knew it was 17,000 and you were going to make 15% or 3,000, great, you do it immediately. Problem is you don't know that. So Greenscreens has an AI powered system that allows you to take the customer's data, feed it to the AI engine, train the engine to get smarter, and then give you predictive pricing so that you can say with a much higher degree of confidence, yes, 20,000 is the right price, let's book it, and let your frontline brokers be able to make those decisions. Well, you could make a 3PL a lot of money if they had that tool, okay? But good luck convincing the customer, to do that. Okay, well, guess what? The thing that Greenscreens figured out was, look, if you're a giant, if you're C.H. Robinson spending $1 billion on tech over the next 5 years, you might think you have a great solution to this problem. And whether your solution's better or not, don't know. But if you're a mid-sized company, you're not spending that amount of money on R&D, you need to be able to compete against them. So part of what Greenscreens figured out was, first of all, sell to the mid-sized guy, not the giant. And then second of all, focus on the pain point. The pain point was compete against the big guys with technology that's as good as what they have, but sort of a David versus Goliath story. And then number three, free demo so that you can use it and see how you make more money. And at the end of the day, that's what everybody wants. How do I make more money? So in other words, by reframing the problem as how do you compete against the big guys and how do you instantly make more money on your transactions, green screen started getting a lot more traction a lot more quickly. And I think so my answer to Ivan's question is the big corporates, first of all, might not be the best customer. Maybe the mid-sized customer is better. And then secondly, if you figure out what the real pain point is, they're not going to move so slowly. They'll move a lot faster.
No, some great examples, Benjamin. Thank you for that. I want to also bring a little bit the attention to e-commerce. I know that was a topic in your conference last week that came out. I mean, we've seen some statistics that were mind-blowing in terms of the growth in one quarter to equivalent of growth in 10 years. You have all the last mile, you have all the... I saw and I don't know if you liked it, I don't remember, but there was somebody that posted on LinkedIn something to the extent of e-commerce is a new store, the store is the new warehouse, and we need on-demand delivery, something to that extent. We also have question here that kind of links, door-to-door solutions and all of this, right? So I mean, it's a big mess of a question that I'm just putting on you, right? But I let you break it down a little bit and talk about your thoughts in this whole concept of e-commerce growth and what it would mean.
Okay, so a couple of things. When I think about e-commerce, there are a couple of parts to this. Much has been made of the McKinsey analysis that showed that in one quarter, the first quarter of COVID, we had 10 years of e-commerce growth and penetration. And effectively another 10% of the retail market shifted from in-store to e-commerce. What that's meant for logistics, several ripple effects. One is last mile, where if you're in B2C, 41% of the supply chain cost is actually the last mile and the last mile delivery. And so for them, the opportunity to use e-commerce as a catalyst to drive more growth in that arena has been fantastic. A second is reverse logistics. So what you return in stores on average is about 8%, but what you return from e-commerce purchases is about 25%. So as e-commerce growth has continued at approximately 20% annually for the last now 20 years, growth in reverse logistics follows that. And so that's been kind of a second winner. Third is e-commerce fulfillment. When you buy something online, how does it get to you? The logistics associated with that. And of course, that's been very good news. That was actually one of the growth drivers for XPO last year, along with others that are in the value-added warehousing arena. So to me, those are three examples of downstream logistics services that have benefited from the massive growth in e-commerce. Now, the question that you shared about last mile, I guess I would break it down as follows. The question of door to door. Look, I think there are logistics companies that historically just did B2B. But when you're working from home or buying from home, that last mile and how it gets to the consumer doorstep becomes all the more important. That's very good news for logistics companies that do B2C. So XPO has a division, a company called 3PD. That was one of the first acquisitions, and that division has done very well in this arena. Of course, parcel players, UPS, FedEx, DHL, but also some pure play logistics companies. Hub Group buying nonstop delivery recently is an example of this. JB Hunt has made a string of acquisitions. So has Forward Air. All these guys are making moves because they have to get into that. The interesting thing is technology companies that serve last mile can do even better. And like one of our portfolio companies, Bringg, really is sort of the e-commerce engine for that last mile. And I guess my advice would be, if you're looking to do more in last mile, you could look at the services companies, but also look at the technology companies, because there are lots of areas in which you could invest or acquire that give you that true door-to-door capability that you were asking about.
I want to also ask you a little bit, Benjamin, from an investment banking M&A looking at the target perspective. What do you look at when let's say you're on the buyer side or seller side? I mean, what are some of the tips and tricks? Obviously, when people know that you were looking at buying their company, I was having a discussion with the private equity person a couple of weeks ago. They come to you with some nice looking numbers, right? I mean, they don't tell you the story, they don't tell you the truth, right? They try to obviously put it in the best possible way. I guess what are some of the tips and tricks to not fall for, the fluff in some ways, and at the same time to dig a little bit below the surface and to identify which is truly a good deal and which is not?
Yeah, well, I mean, look, I think it's a good assumption that if a banker is selling it to you, he's got a story to tell, or she. I think Herb Allen was the banker who said, I could teach my dog to be an investment banker over a long weekend. It's not that hard. But fundamentally, the banker's job is to tell you a story and to tell you why he or she thinks it's a great business. So when I look at a banker book, I mean, first of all, I always flip to the last page. I flip to the financials because I guess you can lie with numbers, but it's a lot harder to, right? I mean, and if you know what to look for, look, I mean, as an example, there's a freight forwarding company that's in the market right now, and we looked at it. Cambridge Capital did, with another private equity group, and they had a great 2020. But here's the thing: when you look at the line items, you realize that portion of that was, you notice that their margins, so the net revenue as a percent of gross revenue were significantly higher last year. So you go, okay, why? Well, and then you unpeel that. Well, it turns out the margins were higher in part because of the fact that they were moving some goods on a PPE basis, right? If you were moving PPE, maybe the government didn't care what they were paying, and maybe that logistics company was able to charge more because of the scarcity value. Okay, fine. Or maybe they were moving freight from one lane, from one origin to another destination where there was that much more of a capacity crunch, and as a result, they were able to jack up their margins. That's great, but is it really sustainable? I in that particular case, my conclusion was no. So I think to me, number one is flip to the back page and look at the numbers. Number two is ask yourself the question, what is it that they have that's really great? So, I mean, as an example, I'll give you an example of when we invested in Bringg. Actually, there wasn't a book, but nevertheless, the question that we asked was still, what makes it great? And our conclusion was they were doing something unique. They really had an e-commerce platform that major brands like Walmart and McDonald's and others could use that really separated them from the pack. Blue chip customers, when it's an earlier stage company, pretty good sign as an example. So, but again, question number two, what are they doing that really separates them? And then number three is, why is this opportunity coming to me, right? In other words, as a private equity buyer, I am unlikely to ever be the right buyer for, back to the example of freight forwarding, a freight forwarder in a market where there are strategic buyers that have so much synergy, right? I mean, like if DSV wants to buy a freight forwarder, they should be willing and able to pay more than a private equity buyer because they have all these cross-selling synergies and SG&A overhead that they can take out. So guess what? I'm usually not that guy. What I try to do instead is look for situations where I could bring something unique. For me, the unique thing is we have a fantastic management team and a set of operating partners. Some of them like Issa Al-Saleh. Issa built Agility to a $5 billion public company with a little bit of help from us 16 years ago when we worked with them on the strategy and investment banking side. So, Issa has bought over 40 companies and has built one of the world's greatest companies in the space. The management team with access to, to our team and to people like Issa can really benefit from that. Similarly, some of our other, partners and operating partners, Dave Stubbs built Kuehne+Nagel Lead Logistics, Remus Kapeskis ran R&D at UPS, Morton Meyerson built the world's largest IT outsourcing company and really invented the field and built EDS. Like, these guys are fantastic. So our model is look for great companies and great entrepreneurs who are not just looking for money, but are also looking for a partner that can help in a meaningful way. And so, to me, I mean, that's why we actually don't buy very much of anything that we see through a book. We're usually investing in or buying somewhere between 20 and 80% and then partnering with the management team because they want someone to help them take the business to the next level.
Makes a lot of sense. Wanted to ask, there's a question that comes from Latin America. One of our friends, Demo, is asking, what is the view of Benjamin about Latin America, specifically after the investment on a LATAM unicorn? Now, I haven't followed. I don't know if you guys have invested in a LATAM unicorn. I'm assuming that's what he's asking, but over to you.
Yes, he has. You're right. We did invest in a company called Lifted, and that company is really using technology to automate transportation in general and last mile in particular throughout the region. Multiple markets, Colombia, Brazil, Mexico, and a variety of others. And what is exciting about that business is, the Latin American market is enormous. It's also relatively untapped. If you compare it with the US market where there's tremendous competition. I mean, I could give you, look, there was $4 billion of capital invested in freight tech in the US last year. A fraction of that invested in Latin America. I actually don't know the exact number, but I think it's about a tenth. Okay, so you have a market that's large and important, but that has a lot less capital and a lot less competition doing automation of logistics through technology, number one. Number two, the talent pool there, is fantastic. I think there was a time in the past when if you wanted to build a tech company, you had to do it in Silicon Valley. That's not the case anymore. There's tech talent all over the world. I mean, there's an article. I mean, here, this is the business cover of the business section for the New York Times today, and it says, "Go toward the heat." I'm here in Palm Beach. This is about the move from Silicon Valley to South Florida and the great transformation, because smart entrepreneurs and engineers are saying, hey, I could build great companies anywhere. I don't just have to be in Silicon Valley. I could be here in South Florida. I could also be in Latin America. And it turns out that Colombia has actually become a hub for great tech talent, interestingly enough. So you have an important market, low competition, lots of talent. And then in particular with Lifted, a business that we're really excited about, a business that is using technology to help automate last mile, working with, large companies as well as mid-sized companies, fantastic team, great entrepreneurial spirit, also great senior talent coming in. Jim Van Leenen, just came in to become CEO. Jim had run many large multinational organizations prior to this, Serva International, which went public, Flash, a string of others. And so, you have a combination of factors that makes the region very exciting in Latin America, and in particular, our platform company Lifted very exciting. So we're bullish. We're bullish on Latin America. We're global guys. We look for great opportunities worldwide in logistics.
We got two questions on this. I'll end with this question regarding, I guess, sustainability solutions and companies that offer sustainable, environmentally positive solutions. Do they make, practical question, do they make lucrative ROI candidates? And just in general, the whole idea of sustainability, I think it's a big topic, and it's a topic that we should all care about, right? So there's that dichotomy, or sometimes it's perceived as not having the ROI, or is perceived as not necessarily making money. So tell us a little bit about your thoughts, and do you also have a specific focus? I don't know, this amount of percentage of my investments need to be in sustainability driven or sustainable friendly solutions?
Yeah, well, we're a big believer in sustainability. We think you can both do well and do good, and logistics technology is one great example of that. I mean, if you think about it, the biggest cause of the increased carbon footprint and emissions and pollution, of course, is energy consumption, which comes from transportation. So transportation can be the solution for that. And transportation can be the solution in several areas. We think of sustainability as, number one, using technology to build more efficient supply chains. So if you've got routing software and your routing software causes trucks to get there more efficiently, guess what? You're saving money and you're also reducing pollution. So that's a double bottom line. That's a double win. Another example is logistics as a category, the idea of bringing in more efficiency into the world of supply chain. If you think about it, if trucking has a 40% empty mile ratio, and because you use better logistics companies, you can get 40% down to 20%. Again, that means the same thing. You make more money and you reduce the pollution. So double win. So I guess you could think about sustainability in incremental ways and in radical transformational ways. We've invested a lot in great incremental sustainability. I mean, XPO is a sustainability play because, again, logistics to help make the supply chain more efficient. So is Bringg, so is Grand Junction because of their use of technology. Now, there are radical transformational plays like electric trucks or hydrogen-powered vehicles. And, we have been less focused on that because those tend to be more risky bets. If you're a $10 billion fund and you can afford to put $100 million into something that might go to zero, then you might make those risky transformational bets. And guess what? We all benefit from that. But I'm just saying that for us as Cambridge, we tend to focus more on investing in great businesses with great people where there's a quick impact through the incremental sustainability benefits on the logistics side and on the technology side. So I would say that really is that kind of green supply chain concept applies to almost everything we do.
Thank you for that, man. Well, on that note, I will bring this to an end. I mean, we have a lot more questions, but I'm also being mindful a little bit of time and of the fact that I need to fix this whole thing that I just created, my own madness of technical primitive that I am. So great sharing. Thanks a lot for joining us. I'll take you also on the questions that came, and I'll send you a separate note so that, maybe you can answer some of this. We had a lot more from coming. Good luck in everything that you do. I also want to, to share obviously with those that, that didn't know Ben. Do follow him on LinkedIn. He's very active. He's sharing lots of interesting ideas. Do follow also the good activities. You put some great events together as well. And I mean, some of it is open to the public. So do keep in touch with Ben. If you have a great idea, also pitch him, I guess. So, you get that, I'm assuming, a lot. So thanks a lot and be in close touch, Ben.
Thank you. My pleasure. And certainly anybody who's listening is welcome to reach out if you have an idea. LinkedIn's probably the easiest, but you can go to cambridgecapital.com or email me at ben@cambridgecapital.com. Happy to be accessible. And our core focus is on investing in great businesses and supply chain, and those ideas can come from lots of places. So by all means, please feel free to reach out.
Thank you for listening to our podcast. If you liked what you heard, be sure to go to www.elcotglobal.com and click the podcast button for all the show notes of the interview. Also, subscribe to our mailing list to get our latest updates first. If you're listening through a streaming platform like iTunes, Spotify, or Stitcher, we would appreciate a kind review. 5-star works best to keep us going and our production team happy. And of course, share it with your friends. I'm most active on LinkedIn, so do feel free to follow me. And if you have any suggestions on what to do and who to invite next, don't hesitate to drop me a note. And if you're looking to hire top executives in supply chain or transform your business, of course, contact us as well to find out how we can help.